Okay, now we talk about our account for notes receivable. So let's talk about that. So accounts for notes receivable. First, we explain the account receivable. So the terms of the account receivable, notes receivable is that it's a page which classify as this. So the term creditor means party to whom money is owed. Debtor means party that borrow and owe money, which means maker or borrower. There's going to be a cost of borrowing, which we call that interest. There's going to be a maturity date up till when this debt or receivable is due. Maturity value at the end, how much money is going to be paid. There's going to be a principal amount, and terms are that length of time for when notes were signed to when payment must be made. It is like that. So this is an example of notes receivable. So principal is the 1000, and interest period start from December 31st. The creditor or the payee is the Continental Bank from Chicago, and the maturity date when it's going to be due, it is on February 28, and the interest rate is given as 9%. And who are the maker of this instrument, promissory note of this account? Sorry, it's notes receivable. They are, I think, Laurel Holland, right? So that was just a picture of notes payable. It can be short term, can be long term, depending on the interest period. If you see that it's less than 1 year, then we call this notes receivable, and if it's more than 1 year, then it is like treated as a fixed under long term assets, under fixed assets. Okay, so we have an example here. So consider in our previous slides, exhibit 5.5, that Lauren Holland signs a note. Continental Bank gives 100,000 cash. The bank makes the following entry. When the bank gives her 1,000 cash, the entry would be that banks make it as a customer, which is notes receivable, and cash is received, so it is a credit side. So notes receivable to cash. Similarly, when you make a sales, you make an entry account receivable to sales, right? But since this is a bank, its sales is cash, so it's a decrease in cash. Notes receivable to cash, because you pay cash, your cash is decreased. So remember, this entry is basically bank's perspective. Bank make this entry. Okay. Continental Bank earns interest on 31st of December, accrue 9% interest rate, right? So amount of interest is like that. We have 1,000, interest rate is 9%, and time is 4 months. 4 months. If we want to find out the 4-month interest, 4 divided by 12, answer is 30. And how are we going to record the interest income for the bank? It is charging as interest receivable, right? You have to receive from Lauren $30, and that is your interest revenue, right? Because banks sales are also interest revenue, right? So how we represents the notes payable, notes receivable in the balance sheet? It is under current assets. So this 1,000 is the notes receivable, and this is the interest receivable. right? Interest receivable here. It is also part of current assets, right? And that is also our revenue. Revenue will goes to, will go to income statement. And now the bank basically collects the note on its maturity. So we know that according to the term or the specimen of the notes receivable, it was issued on 31st of August and has to be paid back on 28th of February. So in between, and this is 2014, this is 2015. In between there is a 2015. So it means on, so interest is due on from January to February, only 2 months, because all of the 4 month interest we already calculated when we make our adjustment entries and make the balance sheet and income statement for 31st of December. So for this December we make it a 4 months, but now up till from January 1st to 28th of February there are 2 months. So how we gonna record it as? So the interest is, so interest gonna be sorry, so the interest gonna be, let me just write it down here, 1000 multiplied by 9% multiplied by 2 by 12, it is equal to 15. Right? And the previous receivable interest receivable was 30, and this is the current receivable, right? So total interest is 45, right? Let me just write it down. It's 45. Just remove it. 45, right? So the entry would be they receive, because question says collects the note. So notes is going to be collected along with its interest rate. So total interest is 45 here. So total amount going to be principal plus interest. It's 1045. So cash receipts against note receivable, right? Against interest received, right? Which is interest receivable, which we make an entry into our previous slide. Interest receivable. So we receive the interest receivable, and current year interest revenue, that would be 15. This is how I've done it. And now the interest rate is expressed in annual percentage, right? If 9% is written there, it means you will receive 9% in whole year, right? If you want to find out the fraction used for time period, if it is for months, then how many months used divided by 12. If for days, how many days the money is used divided by 365, right? This is how we calculate interest.